Now that we have done Visa, let's actually analyze MasterCard, which, let's face it, it is the duopoly with that of Visa, so may as well just do it, see which one is better, which one's fundamentals actually match with the ticker price, alright? So let's get started with analyzing the stock for MasterCard, ticker symbol MA. Starting off, of course, with the dividend summary. MasterCard does actually pay a dividend, a rather small one, just like Visa, of 0.56%, which ends up being around 49 cents a share for an annual payout of $1.96, payout ratio in regards to the net income of 23.74%, with a 5-year growth rate just as big as, actually bigger than Visa, of 18.29, which, again, remember what I said last time, just because they have a really low dividend yield does not mean that their dividend isn't necessarily good. And well, the fact that the 5-year growth rate is 18.3% pretty much just tells me right now their dividend yield is low, but they might be able to continue to grow it further and further because of the past 5 years growth rate. Not 100% obviously, but this is just an indicator that they are able to increase their dividend without an issue. Dividends have been increasing for the past 10 years. Ex-dividend date is actually coming up on January 6th, payout date of February 9th, and they pay out their dividends quarterly. Now coming over here to the calculator, and before we get started, let me just all remind you, of course, I have made this calculator public. So if anybody wants to have this calculator, by all means, go to the discounted free cash flow calculator video. I'm actually going to make a new one. I might even actually make the new one before I put out this one. But regardless, I'm going to put out a new one explaining how to use this new calculator, right? So just go in that video. There's a link right at the top. Make a copy, and then that way you can pretty much just use it, all right? But anyways, ticker symbol MA, market cap of $351 billion, PE of 43.95, almost 44. We would like to buy anything under 20, and well, this is already saying that's expensive. Now, does this mean that we don't buy this? Not necessarily. We're going to take a look at other metrics as well. Share price of $357.48, annual dividends, as you all remember, of $1.96, and the amounts that they pay in dividends per year, according to their shares outstanding, is almost $2 billion at $1.9 billion. And after they pay this dividend, the amount that they have in free cash flow left is about $4.14 billion. So they have a lot of money left after paying this dividend, which ends up being a payout ratio in regards to the free cash flow of almost 32%, which is really good. Ideally, I like to buy anything under 60, and the fact that it's like, what, 31.79, it's very good. It's a very healthy dividend that they are able to sustain. Now coming over here to the actual metrics, we got the net income 5 years ago, $4 billion, to last year of $6.4 billion. Guys, that is an increase of 41%, which is just massive. Just like, actually, I would argue this is better than Visa. I think in my Visa video I said that Visa is better than MasterCard. Now that I'm looking at just the net income alone, I think this might be significantly better. So let's continue analyzing this company. Next, we got the free cash flow. 5 years ago, $4.4 billion to last year of $6.9 billion. That is an increase of 36% with an average 5-year free cash flow of $6.1 billion, which is absolutely massive. In fact, they didn't even have that issue with Visa of, like, I think Visa 2 years ago in the 2-year column, they actually went a little below the average free cash flow. They actually don't have this issue. Now, last year, obviously, they did go down a bit, but yeah, it's pretty much in line with the overall trend. Next, we got the revenue. 5 years ago of $10.8 billion to 1 year ago of $15.3 billion. There's an increase of 29.57%, which is really healthy to see. And we're pretty much seeing the same trend when it comes to pretty much all their profits, right? Revenue, free cash flow, and income, where 1 year ago they slightly went down. So something to take a look at. Maybe they did something here that brought their revenues down or something, or their income or their cash flow down. I don't necessarily know. Do more research, go on their 10K or their 8K and read about it. Next, we got the total debt. And again, one of the metrics that a lot of people just tend not to really pay attention to. You want this to be as little as possible, or at least going down. And the reason is because it's all about staying in the game. If the economy goes bad, if we go into depression or recession, the company with the least amount of debt is most likely to survive. So that's essentially why you want less debt. 5 years ago, $5.2 billion in debt to today of $13 $14.9 billion. Guys, that's an increase of 62%, which is really, really bad. Like, in my opinion, this is significantly worse than Visa. Next, we got the shares outstanding, and one of the most overlooked metrics. You want this to be decreasing. You don't want the company to be diluting you as the investor. You want the company to be buying back shares, right? So that's essentially why you want this shares outstanding to be going down, because it gives you, the investor, a bigger piece of the pie. 5 years ago of 1.2 billion shares to today of 983 million shares. Guys, that's a decrease of almost 10%, which is just massive. Absolutely massive. Really, really interesting to see that. Well, actually, it really isn't that interesting to see. MasterCard is a huge company, is a duopoly with Visa. Not surprising that they're buying back shares, though I kind of wish that their debt was going down too, but it is what it is. And lastly, we got the cash equivalents, and as of today, they have $6.41 billion in cash equivalent, with an average cash equivalents of $7.14 billion. And now, with all of those metrics, we're going to assume a low, a median, and a high assumption for a growth rate of 10 and for a growth assumption of 10%, required rate of return of 10% for the low assumption. For the median assumption, a growth of 15% with a required rate of return of 10%. And for the high assumption, a growth of 20% and the required rate of return of 10%. I'm going to keep the required rate of return, guys, at 10%, mainly because that's what the highest, usually what the S&P 500 does yearly. And kind of, I just wanted to see what this would do when it came to analyzing a company, because I change it up, right? For the low assumption, I usually put the required rate of return lower, but let's just assume that you would want the same required rate of return and only change the growth assumption. Let's just see how much this is going to affect the prices. Now, the target share price, not adjusting for debt, for the low assumption ends up to be around $120 at $119.70. For the median assumption, it's about $141, and for the high assumption, $165 on the dot. Now, adjusting for debt, however, guys, they do have a lot of debt, so that means that this is going to go down, right? The more debt they have, the least value the company has, right? It's just, it is what it is. So, for the target share price after debt, for the low assumption, we get a target share price of $113.14. For the median assumption, we get $134.38. And for the high assumption, we get $158.43. Now, obviously, we do not want to buy this at the price that it is, mainly because of the fact that you really want to have like a margin of safety involved in it, right? I like to add a 5, 10, and 15% margin of safety. And for the low assumption, with these margins of safety, respectively, we would like to buy this at $107.48, $101.82, and $96.16. For the median assumption, we would ideally like to buy this at $127.66, $120.94, and $114.22. And for the high assumption, we would like to buy this at $150.51, $142.49, $142.59, and $134.66. Current share price, guys, is $357.48. So the fact that I'm getting these numbers, even for the high assumption, right? Let's just assume a 20% growth assumption. We need this to drop more than half at this point. Look at this. The highest price with a 5% margin of safety is 150. Let's just say you don't even want a margin of safety. 158, 357, which is just completely insane. This needs to drop by a significant amount. And to those people who say, oh, it won't happen, guys, the ticker price goes with the fundamentals. Eventually, the company will be what the fundamentals usually say. Now, the company can go undervalued and it can go overvalued of these fundamentals. However, they will always just average out to the fundamentals. So I honestly believe that if this is what I'm getting for this, then I think that the price should be at around $158, $160, maybe $170 at the highest, right? It really all depends on your growth assumption. But just for me, this is expensive. It's a good company, but way too expensive right now. It's not worth buying it. So that's just my opinion. Like if you like, comment, subscribe. It really does help here with the algorithm. On YouTube, you can follow me on my new tech sites, BitChute, Odyssey, and Rumble. When I just do my stock analysis videos and crypto videos, you will get exclusives as well. So with that said, peace out and be on the lookout for the next stock analysis video.